Market headlines move fast, but emotions move faster. A common and understandable question is, how can I invest my wealth without constantly worrying about the market? While market uncertainty can never be eliminated, reframing the risk can help you stay focused on long-term goals rather than short-term noise. 3 tips to help you invest with greater peace of mind. First, understand your risk. Humans are good at identifying risk, but naturally poor at quantifying risk. Most people are more afraid of sharks than cows, yet more people are killed by cows each year than by sharks. The same logic applies to the stock market. Most people are fearful of large market drawdowns. While large market drawdowns are certainly detrimental to long-term investment success, they aren't the biggest risk. The greatest risk to long-term financial success is the erosion of one's purchasing power, also known as inflation. The highest failure rates for retirees weren't experienced by those retiring in 2000 or 2008, but by those that retired in '68 due to the inflation of the '70s. The best way to protect yourself from inflation is to be invested in appreciating assets. Once you reorder those risks, you can better understand that there's a greater risk of being uninvested and suffering from inflation than being invested and incurring volatility. Like the cow, the greatest threats tend to be slow and persistent rather than sudden and rare. Up next is time in the market. Portfolio returns are heavily impacted by a few great market days over one's lifetime. For instance, if you miss just the 5 best days in the market over the past 36 years, your portfolio would have been 37% lower. That is only 0.04% of all days over that time frame. If you miss the best 50 days, your portfolio would be 92% lower. Obviously, it would be great if you could capture the best days in the market and avoid the worst. Unfortunately, the best days in the market tend to be clustered around the worst, and without a crystal ball, no one has any idea what a daily return might be. Therefore, the best strategy is always to remain invested with the understanding that market volatility will happen. Fortunately, we know that it is the bad days in the market that create the opportunity for greater market returns in the future. And finally, create a plan before a market event. Now that we know what the biggest risk is and that always remaining invested is prudent, we need to create a financial plan and find the right investments. A financial advisor can help you discover what your goals are, what your risk tolerance is, craft a diversified portfolio to limit volatility, help your portfolio meet your spending needs and offset the effects of inflation, to provide long-term guidance during the inevitable market decline. Partnering with a trusted advisor can be helpful for someone who has little experience in the markets, or even for someone who has experience but would like to free up their time to focus on more important things in their life, whether that's family, a business, or a hobby. While investment returns are quantifiable, it's often the unquantifiable value of prudent advice that goes overlooked. It's best to obtain this advice ahead of a market event, especially if it allows you to stay invested and reap the rewards of the best days in the market. At PYA Waltman Capital, we help individuals and families invest with clarity and confidence. Through value-based planning, disciplined investment management, and thoughtful coordination with other professionals, we work to align financial resources with what matters most and reduce the anxiety that often accompanies market uncertainty.